Folks, the Fed just flipped. They did a pretty damn big flipperoo. We need to discuss it and the implications. And then I need to walk you through some violent economic data that we are getting, specifically an incredibly infuriating report on the American consumer and how they are doing in this current economy. Let's get right into the work, timestamps below. Okay, so the Fed has flipped in a not so subtle way. If you go back to the CPI release last week, when the hot 9.1% year over year report came out, we were talking about how markets had essentially panic priced in a 100 basis point hike because of that particular data set. Well, over the following days after that report, you've seen the Fed come out and actually guide down the expectations on how much they're going to be attacking this inflation. And now markets are back to factoring in a 75 basis point hike, and a 100 basis point hike is returning back to being a minority probability. The Fed coming out and guiding expectations lower and setting a less hawkish agenda for future policy trajectory meetings is sending a very clear message to the market and participants in the economy. Markets had increasingly thought the Fed was moving to actually preempt higher inflation and more aggressive, more persistent inflation like we've been seeing carried forward into the future. But instead, the Fed is signaling that they are reverting back to the transitory era way of thinking. The strategy of assuming inflation is going to go down before it actually starts going down, and making policy decisions that don't preempt higher inflation, but instead preempt inflation no longer being a problem. Remember, folks, the thought process on holding off on raising rates at all when this inflationary spiral started was, oh, we should not try to preempt more inflation because the inflation numbers are transitory anyways. Obviously, that did not end well. Right now, the basis for holding off on further preemptive strikes on further inflation is very similar. Charlie, 75 basis points is enough. Isn't that enough, Charlie? Folks, a 75 basis point hike could have been justified 6 months ago when we had the first report of about 40-year high record inflation. It doesn't come close to preemptively striking further inflation or even reacting to recent data that's in the past. If the Fed follows through with what they're guiding the market on, the Fed is going to be making the same mistake it has already made about a dozen times before. Look, folks, right now there's a general understanding that, hey, this June report was hot, but it's probably a short-term peak because commodity prices and specifically energy have plummeted. Okay, I agree with that. Pricing pressures should cool off in the main worrisome line items over the next couple of months. But what about after that? Are we so sure that commodity prices aren't going to have another cycle to the upside and accelerate all these same pricing pressures at a similar, if not worse rate than we've already seen this year? In fact, it was just last week when we were hearing, oh, oil prices would never go above 100 again. Guess what happened this morning? Above 100. Are we so sure that the same factors that skyrocketed these energy prices are not going to have another go at it later on after this short-term temporary pullback in inflationary data? Are we so sure that if the unlikely scenario happens that we're going to enter into a massive recession, that oil prices as a whole won't plateau at levels that were much higher than they were pre-pandemic? Are we so sure that we won't enter into a stagflationary environment where the economy is dumping and inflation is still well above the Fed's target rate? When you say inflation is peaking, okay, we're at 9.1% year over year. If this last report was indeed a peak for this cycle, and it goes down to, say, I don't know, 6.2% by October, that is still extremely outsized. That's about 3x the Fed's target rate. That combined with an economic slowdown is going to be a disaster. So the idea that the Fed is already declaring a downtrend and a partial victory before we've seen any of this play out this early in the cycle after so many mistakes that we've already seen the last 3-4 quarters is quite frankly atrocious. I was reading what David Solomon was saying this morning, the CEO over at Goldman Sachs, and he was saying that inflation is deeply, deeply entrenched into every aspect of the economy and the global economy. And it is unclear whether the situation is going to magically improve by the end of the year. Yet the Fed is acting like it's basically a guarantee. You have Fed members going out and having a beer and saying, oh, this inflation thing, it's behind us. It's a thing of the past. The Fed needs to look at the data and consistently take stronger action as the data suggests is necessary. You don't stop attacking before inflation even shows that it's starting to pull back. This is the most important time to act and preemptively strike out future waves of inflation that are going to be much, much harder to get under control in the future. Imagine you're in a boxing match, one-on-one, and you're punching it out. And then all of a sudden you notice that your opponent, he's getting tired. He's getting real tired, and he's letting his guard down, and he's leaving a little piece of weakness for you, a little beautiful window of weakness for you to just totally knock him out and seal in the win. What do? Do you decide, oh, you know what? It would be rude. I'd be a little rude, Randy, if I just totally took advantage of the situation and preemptively struck him before he got back up and gained the edge back on me? No, the time where you see that he's tired and his guard is down, that's when you want to strike the hardest. That way you could seal in your win before he regains his strength and regains the edge back on you. Right now, the Fed's saying, hey, you know what? Inflation's guard is coming down in the next couple of months. It's not even down yet, but inflation's guard should be down at least in July and in August. Now's the time we want to be less aggressive. We don't want to stamp this out and nip it in the bud while we can. No, we want to be less aggressive and just hope that after this cycle plays out, that he doesn't come back swinging, that he just tires himself out on his own. And that is a big mistake. You have to use weakness to secure your damn win. It would be one thing if the Fed was right on the trajectory of inflation the last 4 times they predicted it. It's a whole other thing when they've been wrong again and again and again. If the Fed is more aggressive, that's going to be terrible. Terrible for the market in the short term, but eventually we could actually get out of the cycle and it would be better for everybody involved. But instead we have to learn the hard way and drag this out as long as possible, and perhaps even risk a deep stagflationary environment by doing so. And look, I get it, the Fed doesn't want to risk any more than they have to, pushing us into a deep recession. But if they are wrong on this gamble, they're going to have to do much, much worse 6 months from now when the economy could be on much, much worse footing. And if you want to understand the market's thought process and why it's been flirting a bit more with the green trend, if you've been following it as of this morning and the end of last week, before it tanked towards close today? Well, it's thinking from a multiple standpoint, hey, wait a second. We expected the Fed to be a lot more aggressive over the next year or two at stamping out these inflationary pressures, but now the Fed is starting to cut back a little bit. It's starting to suggest that it's going to continue to trail inflation instead of preemptively strike it. And if the Fed disconnects itself and accepts a higher rate of inflation because of that policy trajectory, well, that means that the peak rate that the Fed is actually going to reach is probably going to be lower and faster reached than expected. And if you look at this chart hither, in green you can see market pricing, and then this dark blue line shows where we are currently. Markets are expecting right now the increase in rates to take us to around 350 basis points and then peak there and start cutting as early as the beginning of 2023, right? So when we see the Fed slowing down and indicating or signaling that they're not going to be as aggressive at tightening even though we have this insane inflationary report, well, that basically convinces markets that perhaps we're going to peak at peak rates lower than markets had already sold off on, which means that markets can have a short-term valuation climb on that. And that's something that markets want to be bullish on because all of a sudden companies are worth more and multiples make more sense if rates are peaking lower. But also at the same time, markets are like, wait, but what about the long-term impacts of runaway inflation? The longer the Fed trails inflation, doesn't that also mean the more likely that sometime down the road, if it's not this year, next year, or 5 years from now, we're eventually going to have to Volcker things up? I mean, the 10, 12, 13 years before Volcker, you had overall running away inflation and central banks did not have the guts to fix it. Some people in the market may be thinking right now, hey, maybe that's what's going to happen again, and then maybe another 5 to 10 years from now, we're going to get the massive tightening cycle. A 75 basis point hike or a 100 basis point hike at this coming meeting in about a week and 2 days isn't a huge difference, right? It's just one meeting and 25 basis point differences. But overall, it sends a very, very powerful and clear message that the Fed is undermining their own fight on inflation and will likely continue to do so over the coming meetings as well, which could drag this crisis well into next year and also create this environment where the Fed has to either accept inflation well above their 2% target, or the Fed is going to have to Volcker things up. Like I said earlier, there's a long way to fall from 9.1% to get to that target. If you get plateaued and stuck somewhere around 5, 6, or 7%, that is a disaster, a complete disaster. But anyways, moving on, I want to talk to you about today's economic developments. It's always fascinating to me to see how media covers the same news stories. For example, CNBC this morning took the positive perspective. It said, Goldman Sachs crushed analyst expectations on strong bond trading results, shares rise 4%, and Bank of America revenue tops expectations as lender benefits from higher interest rates. And if you are just glossing over the headlines, you may be left with an impression that their businesses are booming, right? But then you go over to the Wall Street Journal. Goldman Sachs profit falls as deal boom sputters. The bank's profit fell 47%. 47% in the second quarter. And then Bank of America profit falls 32%. Terrible, terrible numbers, right? And what's crazy is these two media outlets looked at the same earnings report, the same numbers, and came up with completely different ways to frame it. It's kind of like if you went back to your family and you're like, hey, I earned 50% less this quarter, but that's actually good news because you were expecting 55% less. Technically, you lost 50% of your income, but it wasn't nearly as bad as your wife was expecting, so maybe she'll let you move back into the bedroom. That couch sure is uncomfortable, ain't it? And financial firms are the first to feel a lot of pain when you get into a financial tightening condition. But I want to focus on the core of the American economy, which is the American consumer. How are they doing? Because everywhere you look, people are just like, yeah, things are rough on the macro, but the consumer is strong and the consumer will continue to be strong forever. And look, we really do have a pretty damn tight labor market and wages are going up nominally year over year. People are getting paid more than ever. So you could say, well, I don't really understand how the American consumer could be weak. Well, look at this. A survey that just came out a few days ago said that 75% of middle income households feel their income is falling behind the cost of living. 75%. Middle income is defined as households earning between $30,000 and $100,000 a year. So the question then becomes, well, are they right? Obviously, if you look at economists and politicians who have never had a normal job or been average Americans a day in their lives, they're saying, no, actually, you're stupid. This is the strongest economy you've ever seen. So I guess the question becomes, is America's renowned middle class really just a renowned group of complainers who don't appreciate anything? How is the average American doing if you look at the government's own data? Well, if you look at this data from the Labor Department that showcases nominal earnings and the real earnings inflation adjusted, you have two completely different stories. In nominal earnings, we are way above where we were for the last decade pre-COVID. And average weekly earnings have risen by 4.2% from a year earlier. So to be completely fair, I mean, the average American is doing better right now in terms of sheer number of dollars earned versus how they've historically done. The problem though is that's an irrelevant metric. If you use this as a metric for success, that means that the most successful governments were the governments in Weimar Germany or in more recent times Venezuela. But what about real earnings when you actually adjust for inflation? Why would you do that, Charlie? That means that numbers are going to be worse. We can't just print everything and then say that things got better. Well, real earnings have fallen 4.4% year over year. 4.4%. So they haven't grown 4% plus, they have fallen 4.4% year over year. In fact, if you look at this period here, starting at where the COVID lockdowns were, real and nominal earnings pushed up dramatically due to stimulus, and it's almost as if we stole from the real earnings of the future and spent it all in this one time period and now are paying for it. Oversimplification, but hey, that is how it's playing out, right? And net in effect, I mean, American consumers are doing worse, not better, year over year. And if you look at the last decade, you're seeing real earnings drop at a pace that makes the Great Recession blush. Makes it blush like a young schoolgirl that just met her first crush. That cute Jerome Pow Pow across the hall. She likes him because he seems so carefree. He believes that even if he doesn't study, I mean, the teacher can just give an infinite amount of A's, right? And there's no ramifications. And one day he'll show the world that that's true. But anyways, net and in effect, a lot of folks look at this and they believe that there are going to be no impacts moving forward. They believe that folks can keep spending at levels that exceed their income, dip into their savings, and max out their credit card debt, and there's no writing on the wall that is ever going to be read. To me, though, that just seems like a ticking time bomb, and it is what it is. And what are some middle-income folks saying they're going to do in order to fight this inflation? Well, 71% said they'll eat out less, 69% said they'll delay tech upgrades, 62% said they'll buy fewer clothes and accessories, 54% said they'll cancel or delay travel plans, 54% said they'll drive less, 49% said they'll cut grocery spending, 45% said they'll delay home repairs, renovations, or upgrades, 42% said they'll cut subscriptions like Amazon or Netflix. Seems like they've already been doing that last one. 30% said they'll start buying used items at yard sales and online marketplaces like on Facebook. 25% said they'll sell things they own. Think about the rippling effects of this throughout the economy. Think about how the destruction of purchasing power leads to less purchasing. So anyways, this is my latest update in terms of what I am seeing in this current market. It's a rough world out there, but we're going to get through it. There's going to be a lot of opportunities both on a short-term trading basis and on a long-term short-term horizon. But we have to keep our eyes open, stack up some dough, and make sure that we're staying informed every step of the way. And hopefully I can help you do that. But anyways, folks, that concludes this video. Make sure to let us know what you think down below. And of course, hit that subscribe button to keep up to date with us. If you want to get up to 10 free stocks while trying out an excellent trading app, I'll put a link down to Moomoo down below. If you want to join our ZipTrader U program for lifetime access to our step-by-step lessons, private chat, daily morning briefings, as well as our full price target list and all of our other trading resources, I'll put a link to ZipTrader U down below. Have a good one, folks, and I'll see you in the next video.